Millionaire Maker, and we are here as we are every week with Steve Moore, the economist, advisor to the White House for the past 4 years. He is so smart, so intuitive, and explains everything clearly, which is why we've come to you, Steve. Explain why is a concern of inflation causing the stock market just to go wild, tech stocks down. What's going on?
Hi, Hillary. Good to be with you. And let's start with what happened this week, which is that $1.9 trillion spending bill passed Congress. It was signed into law by the president. So people in the next month or so are going to start getting those checks, and the businesses will be getting the money. And there's a lot of unemployment insurance money. So there's going to be a lot of money sloshing around in the economy. And don't forget, Hillary, that's on top of the $1 trillion that was passed by the previous bill that still hasn't been spent. So you're talking about $3 trillion of money from government that's being pumped into the economy on top of what the Fed is doing. That's an extremely accommodating policy. And that's a lot of money. And you know from Economics 100, what is inflation? Inflation is too many dollars chasing too few goods. So if you put all that kind of money into the economy, you would expect prices to rise. And I would submit to you that we are starting to see a rise in prices. I filled up my tank at the gas pump a couple of days ago, and I paid over $3 a gallon in Virginia. And it used to be well less than $2.50 just 6 months ago. So those are pretty large increases in gas prices. Go to the grocery store, you see the price of meat and other produce, prices are rising. So I do think we should be worried about inflation, not hugely. I'm not saying we're going to have, hyperinflation, but I do think prices are going to rise. And when prices rise, Hillary, as you know, you taught me this, when prices rise, interest rates rise, because part of the interest rate is how much inflation will be. So we may be coming to an end of this era that we've had for the last 10 years of very low inflation and very low interest rates.
So if we have high inflation, what does it mean for, well, actually, not high inflation. If we have rising yields like we do right now, what is the implication of those yields rising for the tech stocks, for NASDAQ? It's just basically that's finance 101, which is just simply that the present value becomes when you bring back the value of a stock to the present, and if rates are that much higher, it means that the stock is very much more, I'm sorry, Steve. You know what? It's also confusing. What would you say that Powell has on his plate to worry about?
Well, first of all, remember that higher inflation is the enemy of the stock market, right? Because higher inflation reduces the value of assets. That's what an inflation rate does. And so, again, I'm not saying we're going to repeat the 1970s, God forbid, but Hillary, that was the worst decade since the Great Depression for stocks. Stocks from 1968 through 1982 lost over 60% of their value in real terms because of the runaway inflation and also the high tax rates. So yes, investors should be very, very careful about where we're headed with respect to these rises in prices. When the prices rise, the bond interest rates rise. When that happens, that tends to reduce the relative attractiveness of stocks. And so, especially these tech stocks, you're right, those are the ones that were really attentive to what's happening to interest rates. And it's a tricky time. I don't think we've lived through this in a long time, Hillary. So a lot of investors have never really experienced an inflationary environment.
I know, I don't usually, kind of diverge with a story, but I think it's important to point out that I went to Wharton. I worked under Jeremy Siegel. I was a TA in his finance class. I helped with research. And as much as I thought I knew, I still to this day can't believe the impact of Fed policy, bringing rates down, cutting rates, how it just is amazing, how it just correlates to bring that stock market, just like you just brings us right into a bull market. It's unbelievable. So what happens when the Fed starts to tighten, which is what they're going to have to do if we have a lot of inflation?
Well, right now, the Fed doesn't show any signs of tightening. I believe you're right that they will have to, but I listened carefully. Maybe you heard something a little different from what I did. When it's always hard to figure out exactly what these Fed chairmen are saying. They always seem to speak in some kind of foreign language. But I heard him say, "I'm not too worried about inflation." Now, that could change quickly, because we see every day that CPI, it's heading up a little bit each day. And I think the Fed's most important responsibility is to keep prices stable. I'm a guy who loves stable prices. I want the dollar to be good as gold. I want prices to be stable and predictable. When you've got prices that are going up and down all the time, it's hard to invest because you don't know what the real value of the returns are going to be. And, the profits of a company are, if they're all eaten away by an inflation, then the profits aren't real. You know what I mean?
I do. And then, I mean, the other problem is that we have, look, we have all this money we've printed. What anybody you ask on the street, if you said, what is this, like, what's it about? Like, where does it come from? How we print money and we print money by selling bonds. And when those bonds people aren't interested in buying those bonds because they don't have faith in our economy and our market. That's when they stop buying and rates start rising. Okay, so that's kind of like what the equation is all about. So what happens? What's going to happen to this stock market? That's really the question.
Well, let's talk for a minute about the bond market, because the question is, if we start to see higher inflation, then bonds aren't a very good buy either, right? Because you're being repaid those bonds at dollars that are worth less than when you lent the money, right? So inflation can be negative for both bonds and stocks in terms of the real return. And that's why, as I want to go back to this idea that the ideal monetary policy is to keep prices stable and predictable. Now, the stock market's been on a tear. I've been surprised at how strong it has been. I do think, people should be a little bit risk averse right now. The market looks pretty pricey to me, especially some of those tech stocks that have gone up so much over the last 2 years. You reported on that week after week, and it almost seems like those prices defy gravity. But, I want to warn people, and I'm not a doomsayer, but it is not at all out of the realm of possibility that we could see a 20 to 25% correction sometime in the next couple of months.
Steve, I'm really with you on that. No one thinks of me as anything but the girl with the rose-colored glasses who always sees the best in stocks, and it always works because the stock market always does go up ultimately. But I'm very concerned right now, just what you said, let's call it bingo. 20 to 25% fall in the stock market is very possible. And that's because as rates rise, it becomes more expensive for companies to do business. It becomes more expensive to buy back stock, which they won't do, which has been all this financial manipulation, or to borrow in order to pay dividends, or for that matter, to make acquisitions, and their products become more expensive. And, with inflation, and then that gets passed on to the consumer. So I would say I'm with you on that. Everyone has to be careful. And there's millions of new investors in the market, which is phenomenal because the market's where you're going to be make millions. But part of making millions is knowing when to sit on your hands, or when to sell, or when to buy a put. So, stay with us for the next segment. I want to talk about a few stocks that have some potential actionable advice to them. Steve Moore, economist, will be right back with The Millionaire Maker.